All right. Well, good morning, friends. Good morning, Shankaran. Good morning, Ganesh. Alok. Good morning, Arun. Good morning, Anand. All right, friends. So we start from where we had left in the last lecture. We are dealing with deductions under Chapter 6A. What we had done the other day is we've took up the general provisions, the rationale of providing deduction. We've understood that, and we saw a very important section 80C, which deals with deductions to individuals and HUF. So from your examination point of view, where there is a more thrust on computation of individuals, well, the section assumes a lot of importance. Now, I totally get that, it is a kind of a complex section. There are so many different items where a person could invest. And therefore, how do I remember it? The logic is, clear. Why the deduction have been given once you understand that. See, one thing is deduction cannot exceed 1,50,000 rupees. So whatever the investment an individual or HUF could make, but the maximum deduction is capped at 1,50,000 rupees. Again, when you read it a couple of times, I'm dead sure that you'll remember all of it, and they're not that difficult. Absolutely not that difficult. Apparently, it seems at times to be a little complex, but a couple of readings should do the trick. What we had done that day is section 80A, wherein we said that deductions are contained under section 80C to 80U, and then we said that no, the deduction should not exceed the gross total income of the assessee. So deduction would never lead into losses. Similarly, we said that you're not to claim deduction twice. There should not be a double deduction, a case of double deduction. So say for instance, a particular deduction is available under section 80 IAC. In that case, you're not taking a deduction under 35 AD again for the same amount of expenditure. So either you claim deduction under 35 AD or 80 IAC. Although 80 IAC is not in your syllabus, but then what I'm trying to emphasize is double deduction is not permissible. Similarly, there was one heading that we were talking of, and that was heading C. In heading C, we said that all profit linked deductions are available in heading C. Okay. And in order to get these profit linked deductions, we got to file the return of income within the due date. If we're not filing the return within the due date, we lose the deduction. So very important to understand heading C. We've got a couple of sections under this heading C applicable in our syllabus. We are going to take them tomorrow anyways, but then for claiming those deduction, one very particular condition is that you should file the return of income within within the due date prescribed under section 139(1). Now, so further, we went on to section 80C. We did go through each and every item of the section. We were onto the residential house property, where a person pays installment for the loan of a residential house property. That is something we were on to. What I intend to do today is I intend to take up a few case studies, a few MCQs. I intend to take a few MCQs, and we also understand the provision in the process. It would become a little more simpler to remember and understand. So first, let's start with an MCQ this morning with Subhashish. I hope he's there in the batch. See, look at this. So now for the MCQs, I'm not giving you too much of a time. We'll discuss straight away. You just look at the MCQ, try and answer as fast as you can. The idea is to discuss the provision along with the MCQ. Okay. So we've got Mr. Subhashish has a gross total income of 1,20,000 during financial year 22-23, and he has made contribution of 1,50,000 in public provident fund maintained in the name of his spouse. Now look at this. The income is lesser than the available deduction. So public provident fund, yes, we have seen the provision relating to public provident fund. Any contribution to a public provident fund set up by central government in the name of any person specified in subsection 4, right? So in subsection 4, they say it is individual, his spouse, and his children. So any of them, right? So it could be individual himself who could hold a PPF account. It could be in the name of the spouse, and it could be in the name of the children. So family members are covered. Here, what Subhashish has done is Subhashish has invested 1,50,000 in the name of his spouse, or in the account, in the PPF account of his spouse. That is available as deduction. But then, friends, even though it is available as deduction, the deduction would be restricted to the gross total income. That is something we saw under subsection 2 of section 80A. And therefore, it is going to be nil, right? So you don't carry forward the loss. You don't calculate the loss in the first place. So there is no question of carry forward. You don't have to calculate a loss. Maximum the total income could go down to 0. Yes. So I guess all of you got it right. Now, therefore, moving further, then we saw, the provision relating to life insurance premium, wherein we did talk of providing deduction for life insurance. See, I'll just go through the summary of section 80C. See, what did 80C grant us? 80C did grant us deduction in respect of life insurance premium, right? It did grant us deduction in respect of PPF, statutory provident fund, recognized provident fund or approved superannuation fund. This is something that you saw while you were dealing with salary. The employer would contribute some amount and the employee would contribute an equal amount, and both that amount would get into a fund. If it is a recognized provident fund, until to the extent of 12% of the salary would not be included in the perquisite, in the amount of perquisite, and any amount received post retirement would be completely exempt. In fact, for RPF, there is a limit. There is a minimum 5 years term that needs to be served. We'll come to it in a short while. But then these contributions you have seen relating to the statutory provident fund and the recognized provident fund. Now, those dealt only with individuals who are employees. What about others? For others, you have got something called as public provident fund. We did talk of it. Now, employees can also contribute to public provident fund. In fact, any individual could contribute to a public provident fund. Then we did talk of repayment of home loan, which is one very important item of deduction here, because a lot of emphasis and thrust is there on housing for all. And therefore, if you take any loan for a residential house and you are repaying anything, the repayment of the principal amount is available as deduction, not the interest amount. Interest amount is separately covered by section 24B, right? And therefore, only the principal amount. Then we did talk of education expenses, tuition fees. So if you're paying, tuition fees of any other two children, that is allowable as deduction. Similarly, this item is something that we did not see in the last lecture. Term deposit for a fixed period of not less than 5 years with a scheduled bank in accordance with a notified scheme. So it is a tax saving term deposit. You've got a lot of options. Apart from that, one option is 5 years of term deposit provided it is under a notified scheme of the central government. Similarly, subscription to notified bonds of NABARD, 5 years post office time deposit scheme. Then you've got something called a senior citizen savings scheme, SCSS. This is something, a lot of senior citizens do invest practically also in this scheme. Whatever amount is invested, this is nothing but a kind of fixed deposit. Whatever amount is invested in this scheme is available as deduction under ATC. And then we've got something called as the NPS. We'll come to this NPS in detail because we got to deal with section 80 CCD. For the time being, the summary of it is you've got life insurance premium, the ULIP, the public provident fund, the SPF, the RPF, tuition fees. So some items relating to investment and some items relating to expenditure. Expenditure like tuition fees, it is an expenditure. Similarly, repayment of home loan is capital expenditure that you are doing. So these items are promoted. Now, therefore, let's look at one very important provision that is related to life insurance. We have already discussed life insurance. What I intend to do is I intend to take up a question and then we just briefly discuss it again. See, look at the provision. You could just go through the provision. I think the provision could be seen on the screen. See, the objective of insurance. What is the objective of insurance? To provide security to a person on, in event of death of that person, to provide security to the family. That is the core objective of insurance. Now, if we did discuss of a situation wherein, the sum assured, that is the amount which would arise to that person in event of death. If the sum assured is less and the premium is more, now that is not going to help. I want the sum assured to be more. And therefore, they've put a cap of 10% of the sum assured. The maximum premium one could pay is 10% of the sum assured. Similar provision is also contained under section 1010D. So in 1010D, whatever amount is received out of an insurance policy is exempt. But if you have got an insurance policy which is wherein you pay more than 10% of the capital sum assured, well, that policy is not exempt. Similarly, Keyman's insurance policy, you have gone through the provision of Keyman insurance policy under the head of business profession, and you have also gone through Keyman insurance policy under income from other sources. 1010D also covers Keyman's insurance policy, wherein they say that no exemption would be available in respect of a Keyman's insurance policy. It would either be taxable under PGBP or income from other sources, depending on in whose hand it is the maturity proceed arises. Here, if you are purchasing a life insurance policy in respect of any other family member, right? Any of the family member of the individual. So family member would be individual himself, his wife and his children. In that case, deduction is available subject to 10% with effect from 31st of March 2012. Prior to that, this 10% was 20%. So you got to remember two dates. One is, prior to 31st of March 2012, 20% of the sum assured. Post 31st of March 2012, 10% of the sum assured. Now, while they made an amendment in this particular section by reducing 20% to 10%, in the very next year, that is with effect from 1/4/2013, they realized that in case if any of the family member is a disabled or has some chronic disease, in that case, he is not going to get insurance at a lower rate, at 10% of the capital sum assured. Generally, when a person is disabled or he has got some chronic ailment, the premiums are a little on a higher side. And therefore, this 10% was replaced by 15% in respect of those people with disability. That's all. Now, check this particular problem. So we've got Nikita. Can it be seen on the screen? Yes, Nikita. Is it visible? Okay. So just check this out. We have discussed the provision. Now, how do you proceed with the adjustment like this? You know, I don't think there would be a complete problem on ATC or Chapter 6A, but then there could always be an adjustment, and that adjustment could be a little tricky. Although we are taking a complete MCQ over here, but then see, look at the problem. The problem says Miss Nikita pays the following life insurance premium during 20 to 23, right? Financial year 22 23. Who's the life assured? Life assured is the person who's covered by the policy. Now, it is a policy of Nikita herself. Well, it is covered. So you need to know who's the in whose name can an individual or an HUF take the policy? Well, individual and HUF can take the policy in the name of, in case of individual, it could be individual himself, spouse of that individual, and children of those individual. In case of HUF, it could be any member of that HUF. So Nikita herself, it's possible, right? Nikita can always take a policy in her own name. Now, when is the policy issued? We get to know that the policy issued on 15/4/2013. Why does this date assumes importance? Well, the date is important only because I got to know whether it is a policy prior to 31st of March 2012 or after 31st of March 2012. If the policy is post 31st of March 2010, 12, I've got a deduction, I've got a cap on premium, and that is 10%. Prior to that, it is 20%. Now, when I look at this sum assured, it is 2 lakh rupees. And what is the premium she is paying? She is paying 25,000 rupees. Now, here is here you got to play. Since it is a policy post 1/4/2012, the maximum that she can claim is 20,000 rupees in respect of this policy, right? So though she had paid 25,000 rupees, yet the maximum available deduction would be 20,000 rupees. Then she pays in case of husband. In case of husband, it's a policy post 1/4/2012. The sum assured is 10,000 and she had paid a premium of 22,000. Now for post 1/4/2012, see 2012 is a point that you got to remember. This 10% was actually 20%, right? It was thereafter reduced, and therefore maximum premium again would have been 20,000, which should have been paid. She had ended up paying 22,000. We are going to restrict her deduction to 20,000 only. Then the life assured is father. Now, whether premium paid in respect of a policy of father would be covered or grandfather would be covered, the answer is no. We have got specific family members, right? And only those could be covered. So this is not to be given any deduction. Getting my point? Dependent brother, though dependent, yet no deduction, because we are talking of individual spouse and any other child. Married daughter. Now, whether it's married, unmarried, minor, major, whatever it is, you have to provide for deduction. Now, what is the sum assured? It is 1 lakh rupees. The premium paid is lesser than 10%. You have to provide for the deduction, right? So even if she's married, yet you have to provide for a deduction. Yes, and therefore it is not 1,10,000, but it is 20,000 plus another 20,000 plus 5,000. So the answer particularly is BF. A lot of you have answered it right. Some of you got it wrong, but then I hope you understand where you went wrong. Yes, friends, do you get this, everybody? Let's move on to the next set of example. See, look at this now. See, just read it. Mr. X is a person with disability. His father, Mr. Y, pays 30,000 rupees as his insurance premium for a policy with capital sum assured of 1,50,000 and guaranteed bonus of rupees 25,000. What is the amount deductible under Section 80C in the hands of father? I'll just take you through the provision, what the provision says, where in case insurance is on the life of any person who is a person with disability. In this case, Mr. X is a person with disability referred to in section 80U or suffering from disease under 80DDB. We are yet to come to these two provisions, but then understand it is chronic disease or a disability which grants a person at least 45% he should be disabled. Now, what is it? We will discuss it when we discuss the provision. A little, different. So that 10% would be substituted by 15%. So what do you think? Well, a lot of you have answered as A, and yes, indeed, the answer is A. In respect of a policy, in respect of a person who is disabled, the maximum premium you can pay is that to the tune of 15% of the capital sum assured. Now, understand any bonus or return of premium is not part of capital sum assured. Sum assured means what? This is the amount the assured is going to get. No, the family member or the nominee of the assured is going to get in event of any mishappening to his life, right? So you are not to take into consideration this bonus. 25,000 rupees got not to be added. What should be done? 1,50,000 into 15% maximum premium. Now that comes down to 22,500. Had Mr. Y paid only 15,000 rupees in premium, in that case, 15,000 rupees would have been allowed as deduction. Here he has paid 30,000 rupees in premium, and therefore, it is restricted to 15% of capital sum assured. Yes. Now let's move further. See, look at this. Okay. We've discussed the provision yesterday in the last lecture. Mr. Parthasarthi, so the Parthasarthi is there. Yes, he's there in the batch. A government employee contributes 1,20,000 to statutory provident fund, which includes employer's contribution of rupees 70,000. In addition, he also makes a contribution of 40,000 in PPF and 20,000 to Sukanya Samriddhi Yojana account in the name of his adopted daughter, age 2 years. Now compute the deduction under 80C. As far as Sukanya Samriddhi Yojana is concerned, it is available, for contribution in the name of any girl child. Now, girl child would, child we have covered while we were discussing clubbing. It would include, stepchild or it would also include an adopted child. So that is, both of them are included. So even if she's adopted, still, even when she's adopted, you're going to give the deduction in respect of this contribution under Sukanya Samriddhi Yojana. When you talk of the scheme, there are rules relating to the scheme, and it says that one has to, contribute to the extent of 1,50,000 rupees maximum in the name of any two girl children. Maximum two girl childs could be covered under this scheme. Although there is no such, there is no two girl child in under the Income Tax Act. Under the Income Tax Act, there is no restriction. You can invest in the name of any girl child. But the scheme itself restricts contribution to maximum two girl child, and 1,50,000 is the maximum contribution, both under the Sukanya Samriddhi Yojana and Public Provident Fund. 1,50,000 per annum. We were discussing that this ATC is available to both individuals and HUF. As far as Public Provident Fund goes, now HUFs are not allowed to make any contribution to PPF account. Earlier they were, but now as of today, as the scheme stands today, HUFs are barred from making any contribution under PPF. Similarly, here under Sukanya Samriddhi Yojana, maximum two children. The maturity of Sukanya Samriddhi Yojana takes place when the girl child reaches 21 years of age. After 21 years of age, she can always partially withdraw after attaining majority. So until she is minor, the account cannot be withdrawn. Yes. Now, when it comes down to statutory provident fund or the EPF, you understand both the employer and the employee contributes. As far as the employer contribution is concerned, no deduction is available for employer contribution. Employer contribution anyway, which is exempt. Therefore, it is employer who is contributing. You are not the one who is contributing. And therefore, what is available as deduction is only the employee's contribution. Remember, it is the employee's contribution which is going to be available as deduction. So what is the employee's contribution out of the 1,20,000 information given is employer's contribution is 70,000. Therefore, the employee, that is Parthasarthi, has contributed 50,000. So maximum, deduction in respect of statutory provident fund to be restricted to employees' contribution. Then he contributed to public provident fund. Now this is available as deduction, and 20,000 rupees for Sukanya Samriddhi, though adopted, yet girl child and allowable as deduction. So my answer is C. What you missed out is this piece of information. When you get a piece of information, try and understand why the information have been given to you. So Mohammed, I guess you are getting your mistake. Alok. Okay, Alok did rectify himself. Well, Parthasarthi, why not 1,50,000? I hope you're getting it. Yes. Now we move on to the next MCQ. So I hope you're getting it. Well, I'll just show you what the next MCQ is dealing with. Next MCQ is dealing with National Saving Certificates, NSC. Now, this is one instrument which is widely bought, not in practically not today, but some years ago, a lot of people bought this because it had a very lucrative interest rate. The best part of buying National Saving Certificates was that you could claim deduction under ATC. So whatever National Saving Certificate you buy, you get a deduction. And also the interest arising on this National Saving Certificate, though was taxable, was deemed to be reinvested in National Saving Certificate. So now with this background, let's go to the question. See, look at this. Drishti has invested 1 lakh in NSC. Just go through the problem. Well, Subhashi has a query that it is 1.5 lakh rupees per girl child. See what I'm talking of. You could maximum invest in a Sukanya Samriddhi Yojana account to the extent of 1,50,000 rupees. Per girl child. Maximum 2 girl childs are allowed, but the total deduction under ATC would be 1 lakh restricted to 1,50,000 only. So let's assume a person has got 2 girl child and he invests 1,50,000 in one account and another 1,50,000 in another account. The maximum deduction he gets under ATC is 1,50,000 only. I hope I'm making myself clear, Mohammed. Maximum deduction under ATC 1,50,000 only. So you invest 50 lakh rupees, yet 1,50,000. Okay. So Drishti has invested 1 lakh rupees in NSC. Now, one thing is clear, 1 lakh rupees of NSC investment allowed as deduction under ATC. She has also invested in NSC in the past. So in the past, whatever she had invested, she is in receipt of interest. Right. For the current year, she may not receive any interest. She will receive interest of the current year in the subsequent year. But the accrued interest relating to her past investment was computed at 12,000 rupees. So now this 12,000 rupees is also reinvested in NSE. This is taxable to be included in income from other sources. So if you get an adjustment like this, you got to include this 12,000 as income from other sources, and you would also claim deduction under ATC for this 12,000 in addition to this 1 lakh. So yes, the answer is B. That is 1,12,000. This happens only in case of NSC and for no other, no other investment. So it is not a case with PPF where you receive interest and that amount received is not treated as reinvestment. Only in case of NSC. Okay. I hope you're getting it. Then let's move further. Okay. So first we go by the provision. What does the provision say? Education expenses, incurred by an individual as tuition fees. So as tuition fees, excluding any payment towards development fees or donation. Donation is not included. What is included is only tuition fee to any university, college, other educational institution for a full-time course, right? Full-time educational course. So with that in mind, let's go with the problem. I hope it is seen on the screen. Samir, could you confirm? Samir, Mr. Samir, I hope it could be seen entirely on the screen. Samir makes the following expenses. Well, remember, friends, in case of educational expenses under ATC, see, I'm talking of ATC, we deal with education under and another section also. ATE also deals with, interest paid on education loan. There, the definition of family is a little different. Over here, under ATC, this educational expense is available only for any two children of the assessee, right? So Samir makes the following expenses. His own educational expense of rupees 20,000. I did tell you that it is only in respect of any two children, right? So own expenditure not allowed. Education expenses of spouse not allowed. School fees of his minor son studying in 10th. Now this is going to be allowed. Well, Jyoti has a interesting suggestion. Oh, she's of the opinion that I should be using Hindi. Jyoti, I could have, I can definitely, I would love to, in fact. लेकिन क्या है ना, हमारे यहाँ पर हमको इंस्ट्रक्शन है कि ज्यादा से ज्यादा इंग्लिश यूज करना है. देयर आर लॉट ऑफ पीपल हु कम फ्रॉम डिफरेंट पार्ट्स ऑफ द कंट्री एंड देयरफॉर इंग्लिश इज अ मीडियम ऑफ एक्सचेंज. आई टोटली गेट योर पॉइंट. मैं कुछ कोशिश करता हूँ कि इंग्लिश में भी बोलूं और हिंदी में भी बोलूं. डोंट वरी. ओके, आई ट्राई माय बेस्ट. So school fees of minor son, well, this is going to be allowed. School is regular education, full-time education. Payment is made to a school. It is not in the nature of donation or development fees. Normal tuition fees by whatever name called. Now, tuition fees need not be called as tuition fees only. And tuition fees does not mean whatever you give to classes. That is different. Any fees that you pay for regular education of a person would be covered. So school fees of minor son studying in 10th, allowable. Music class fees of his daughter. Now, this is not going to be covered. This is not full-time education. Full-time education would mean, the regular schooling, thereafter your boards, and thereafter going for graduation. That is usually the normal schooling. Or the normal education, normal full-time education. So 25,000 allowed, but 15,000 disallowed. Thereafter, college donation for admission of major son. Now, this is not going to be allowed, right? Tuition fees of engineering college of his son. Now, even though he's major, yet this 70,000 rupees is going to be allowed. Then school fees of daughter who's in 5th grade. Now, this is also going to be allowed, but then remember, we can opt for any two children. So, who am I going to opt, it would be the son in 10th and the son in engineering college. So I'm not going to take the benefit of daughter because any two is what I can claim deduction in respect of. Now, husband and wife, both of them can plan it out. Husband taking for two and wife taking deduction in respect of one of the child, but then they'll have to pay from their own accounts, respective accounts. So yes, the answer would be 70,000 plus 25,000. That is A. Why, Mohammed, do you get why this is not allowed? 10,000? Because you've answered, okay, you have also answered A afterwards. I hope you get it. So that is educational expenses. Going further, let's see the provision. See, mutual fund, equity linked savings scheme. We want people to invest into stock markets. Earlier, there was a lot of, there was not a lot of awareness among people as far as stock markets is concerned. And therefore, in order to promote such equity investment, government did allow mutual fund investment in equity linked savings scheme. So mutual fund and equity linked savings scheme, a notified scheme usually called as tax savers. If you invest there, you are allowed a deduction to the extent of 1,50,000 maximum, all aggregate taken together. Now here, with that in mind, the MCQ. Okay. Gomti. Do we have Gomti in the batch today? Okay, Kavita, why school fees of daughter is not included? Well, we are talking of any two children. So, which two children am I going to select? The ones who, for whom I've paid more of the fees. I've got one son who's in 10th, the other son is in engineering college. Both taken together give me a deduction of 95,000. If I was to take daughter, I would have to drop one of them, right? And that would lower my deduction. Why would I do that? Yes, there is no problem taking higher education. See, we'll come to another provision under section 80E. There, interest paid on loan only for higher education is allowed. Here, both higher, lower, whatever education, it should be full-time education of that person. Okay, good, Gomti. So you have made investment, compute deduction under 80C. See the type of investment Gomti had made. She had invested into debt mutual fund to the extent of 20,000. Now, debt mutual fund is not allowed as deduction. We talked of ELSS. We said it should be equity linked savings scheme mutual fund, tax saver mutual fund. So ELSS is what we're talking of. 50,000 rupees done on 13/7/22 allowed. Then she invested into unit linked insurance plan. This is quite similar to ELSS. You've got some unit linked insurance plan where you make investment along with insurance, and deduction is allowed under 80C to the extent of 35,000 allowed. But then there is a catch. What is the date of contribution? The date of contribution is 15/1/22, which does not fall within this, within the previous year relevant to AY 23/24. And therefore, I'm not claiming this. I should actually pay it during the current year. If I'm actually paying only, then could I claim deduction? And thereafter, pension fund set up by mutual fund. Now, this is also available as deduction. I'll just show it to you. Pension as contributed as a contribution by an individual to any pension fund set up by any mutual fund covered by 1023D. Now, 1023D grants exemption to mutual funds. Income of mutual fund is exempt under 1023D. For the time being, you can just ignore it. But then, yes, pension fund set up by mutual fund allowed as deduction. So I'm going to claim deduction in respect of these two items. So my total deduction is going to be 65,000. D. Yes, some of you got it right. कुछ लोगों को मिल रहा है आंसर. देखो, म्यूचुअल फंड के केस में इक्विटी लिंक्ड म्यूचुअल फंड ELSS is what you can claim deduction for. Right, let's move on. So we did talk of residential house. If you are purchasing or constructing a residential house by way of taking a loan, if you're taking a loan or paying installments, in that case, those installments are allowable as deduction. Similarly, in respect of housing, we also discussed one item, and that was stamp duty, registration fees, or other expenses for the purpose of transfer of such house property. So whatever expenditure is incurred on transfer of the house property is also covered. Here there is no condition that it should be only self-occupied house property. The only condition is that you should purchase or construct a residential house property. So not a commercial house property, a residential house property, and you make payment by way of installments, right? For which you don't claim any deduction under 24B. 24B allows you deduction in respect of the interest component. So principal amount under 80C, interest amount under 24B. Let's check up a problem. Okay. Gopal, I hope the problem could be seen. Well, Abhishek, in respect of your query, the total deduction under 80C in aggregate, taken all items together, cannot exceed 1,50,000. In fact, we are going to come to 80CCE, where we see it is combination of multiple sections where the restriction is of 1,50,000, all in aggregate. If I tend to give more than that, understand how, as a government, if I'm giving you deduction for investment, you would always want to invest. Why would you end up paying tax? If I give you, unlimited deduction for investment, you're more than happy. Nobody would pay tax. Everybody would invest. And therefore, they had kept a cap on it. Okay. Mr. Gopal has to pay 80,000 rupees to a cooperative society annually against house allotted to him. Now, see, look what is covered. They say repayment, in respect of purchase of or construction of a residential house, any installment. So installment is allowed when it is paid to development authority, a company, or a cooperative society, right? So 1, 2, and 3. Company, cooperative society, or a developmental authority like HUDCO, SIDCO. Now, these are Housing and Urban Development Authority. So these authorities or a cooperative society, there are a lot of housing cooperative societies. Now, those housing cooperative societies allot residential houses to the shareholder, and the shareholder could pay them installment towards the house. Now, that is allowable as deduction. Apart from that, repayment of borrowed amount also. So if you make a loan, if you take a loan and buy a property, then you're going to repay the loan. Now that loan got to be taken from state government, bank, life insurance corporation, national housing bank, NHB, right? Or a public sector company, or a public company, or a housing company, right? Housing development company, or in fact even employers are covered. But what is not covered, when I think of this section, what is not covered? Individuals. Like you buy a house from your friend and you're giving him installments, that is not covered, right? You take loan from some of your relatives and you make payment of that installment, that is not covered. So you should take it from bank, or cooperative society, company, or your employer for that matter. In this case, Gopal had taken the house from a cooperative society and he's paying installment of rupees 80,000. This is allowable. He has also paid stamp duty of rupees 20,000 at the time of transfer of the residential house. Now, this is also allowable. We did discuss stamp duty, registration fee, or transfer expenses allowable. Then he has paid a sum of rupees 1 lakh to become member of a cooperative society, right? The housing society who is allotted in the house, he has paid 1 lakh rupees to become a member of that housing society. The term of payment is 10 years, the amount deductible. Now understand, we are talking of only installments. Installments alone would be allowable as deduction, and not any amount paid for uh, becoming member. So share capital is not allowable as deduction. But then stamp duty for transfer, yes, allowable as deduction. So there is no deduction available for this 1 lakh rupees. What you could claim is only 80,000 and 20,000. Do you get this, friends? Everybody? Yes. Parthasarthi, you got it right. It is 1 lakh. Pranav, right. Mohammed, Danish, all of you are correct. Right. Let's move therefore. So until here we had completed yesterday. Then we've got some equity, approved equity shares. There are hardly any, no deduction available. Units of a mutual fund referred to in 1023D utilized for eligible issue. Again, no such notified schemes, but ELSS is one thing which is available. Deposit as a term deposit. We've discussed this a short while ago. Fixed period of not less than 5 years with a scheduled bank. So minimum 5 years of term deposit with a scheduled bank in a scheme framed and notified. So it should be a notified fixed deposit scheme allowed as deduction. Post office deposit, we have talked of it. We have also talked of the senior citizen savings scheme while we were discussing the summary. Bonds of NABARD, right? National Bank for Agricultural and Rural Development. Then you've got, then we have something called as pensions, new pension scheme, or the Atal pension scheme. We are talking of it in a short while. ATCCD. This is an important piece of deduction. We'll come to it in a short while, but understand this is also available under ATC. If now one may think, if there is a particular section ATCCD, why do we need another provision in ATC? I'll just show you a chart and probably it would all be clear. Yes, friends, do you get this ATC? Now coming to reversal of benefits. Well, friends, you take benefit under ATC. You invest, government want to promote you to take insurance. You take insurance. You take insurance in the first year. Claim the benefit. And then, you make an investment in insurance on 31st of March 2023. Let's assume that. So, and you say, I made the investment during the previous year. You're very intelligent. And therefore, you will say that I've done the investment during 22-23. You give me deduction. Okay, the deduction would be granted. In the subsequent year, within 15 days, what you do is you cancel the policy. and take back the money. Now what happens? The idea of taking that insurance itself is defeated. And therefore, in such cases where either you terminate the contract or you sell the investment, I need to reverse the benefit also. So whatever benefit you have already taken, I will reverse it in the subsequent year. So what is that? What are those investments where reversal got to be done? I'll just show you by way of a chart. You can always go by the provision, but then briefly, let's discuss the chart. We take up a problem and you'll understand it in a much better way, I think. I'll just show it to you what happens. Okay. So minimum holding period is prescribed for certain investments, like life insurance premium. If you are taken up a life insurance policy, you got to pay premium for at least 2 years. So if you're paying premium for at least 2 years, only then you would be allowed the deduction which was given to you earlier. What happens if I cancel the policy within 15 days or 20 days? That premium which was earlier allowed as deduction would be added. Now, what happens if you did not claim the deduction at all? In that case, nothing is to be added. What is deemed income is only what has been allowed as deduction under ATC. Are you getting my point, friends? Yes. Then, ULIP, unit linked insurance plan. See, life insurance policy, minimum period of holding is 2 years. So you got to pay at least two premiums. Third year you can cancel, but for two premiums you got to pay. In case of ULIP, the minimum holding period is 5 years. So from the date of commencement of plan, make 5 contributions, right? ULIP is unit linked insurance plan. 5 साल के लिए आपको कम से कम contribute करना है. In case of LIC, life insurance policy, कम से कम 2 साल के लिए आपको कंट्रीब्यूट करना है. 2 साल के लिए आपको प्रीमियम पे करना है. थर्ड ईयर आप कैंसिल कर सकते हो. मिनिमम पीरियड इज 2 years. फॉर रेसिडेंशियल हाउस विच यू हैव बॉट, you are not to sell that residential house for 5 years, right? But here 5 years is not from the date of buying or construction of that residential house. They say 5 years from the end of the financial year in which you have obtained possession of that house. So you should have obtained possession. Okay. Yes. Khojima has an important question. Well, I'll stop myself and first deal with that. In respect of life insurance premium, you got to have a period of 2 years. I've said 2 premium because I just wanted to tell you generally it is the annualized premium that people pay. But premiums could be paid in on a quarterly basis or on a half yearly basis also. It is not 2 half yearly premium. It is 2 complete years. So you should complete 2 years. Only then can you withdraw. So it is not 1 year, 2 years is the holding period. If he is paying on quarterly basis, he would have to pay 8 premiums. Then, so residential house, again coming back, residential house, you get a deduction in respect of installments and the transfer expenses. So transfer expenses you have claimed, and within 5 years from the end of the financial year in which you have obtained possession, you sell that residential house. So if within 5 years you're selling it, the earlier deduction which was allowed would be deemed as your income. Then senior citizen savings scheme, a minimum period of 5 years from the date of deposit. So 5 years at least. So this is quite simple. Senior citizen, it is simple. It is like a deposit. So now you make a deposit of, let's say, 50,000 rupees in senior citizen savings scheme, and you claim a deduction under ATC. In the subsequent year itself, you withdraw 10,000 rupees out of this. Now only this withdrawn amount withdrawn within 5 years, that is 10,000, would be deemed as your income of the subsequent year, right? And not the entire 50,000. Similarly, post deposit, post office time deposit, 5 years of time. Then, some might think why we don't find other items of investment. We don't find other item of investment like EPF or, PPF or Sukanya Samriddhi Yojana, because under those schemes, already a cap is there. Like under Sukanya Samriddhi Yojana, you cannot withdraw until the girl child reaches 21 years of age, or maybe, a partial withdrawal is allowed only after she reaches 18 years of age. Thereafter, under PPF also, you can withdraw only after seventh year, once the 7 year period is complete. So that is, as far as those schemes are concerned, already you've got restrictions and therefore not again given under the act. Where there are no restrictions, you've got minimum holding period of 2 years, and for rest of them 5 years. So, like Danish is asking me whether it is necessary to remember. Well, it's not very difficult. Only in respect of life insurance premium, the minimum period is 2 years. For rest of them, it is 5 years. In respect of residential house alone, you've got 5 years from the end of the financial year in which possession was taken. I'll just share you a small FAQ, and probably you could understand the provision well. Check this. Oi, what happened? This seems to be a little, I don't know whether you could see this. No. I think it would be a little, whether the problem of Khushi, whether it could be seen. Please confirm whether this problem on my screen is visible. Okay, Mohammed, HUDCO is Housing and Urban Development Company. It's a public sector company for housing and urban development. Okay, good. So Ms. Khushi has made following contributions in the past in order to claim benefit under Section 80C, which she had terminated during financial year 23 and 20, sorry, financial year 22, 23. See, what are the items she had contributed for and now discontinued? Failure to pay contribution of unit linked insurance plan. She had taken unit linked insurance plan in 2019, and now she fails to make contribution in 2022. For ULIP, the timeline is 5 years. Minimum 5 years you got to pay. So she had paid for 19, 20, 21, but not for 22. In fourth year, she had discontinued. So if she had discontinued in the fourth year, well, in that case, whatever deduction was granted to her earlier would be disallowed. See, she had paid for 3 years, 20,000 rupees into 3. So 60,000 rupees would be deemed to be her income. She was allowed the deduction. See, benefit claimed under 80C until 21, 22. Then failure to pay insurance premium, right? 19, she took up the policy. She failed to pay in 22. So she had paid for 19. She had paid for 20, right? Paid for 21. So for 3 years, she's paid it. There would be no addition, though within 5 years it has been discontinued. But then, since it is a normal insurance policy, nothing is going to be disallowed. I mean to say, nothing is going to be deemed as income. Then, single premium policy. Now, what is this? See, uh, somebody had asked me whether two half yearly installments would do. It is 2 years of installment that I had to pay. But then my policy itself was a single premium policy. Then there's no question of paying again if it was a single premium policy. But here what has happened is for single premium, they've said that if you discontinue or cancel the policy within 2 years. So whether it has been cancelled within 2 years, the answer is yes. See, I took it on first 1/10/2021. I should have continued it until 30th of September 2023. Then 2 years would have been completed. But then since I've cancelled it beforehand, this 50,000 rupees of deduction, which was earlier given to me, would be added. Then sale of house property. Now, this is a little different adjustment, although I know that 5 years time is given, but then 5 years from the end of the financial year. So when it was purchased in 2017. The end of the financial year would mean 31st of March 2018. 5 years here, 5 years thereon would be 31st of March 2023. I did not have sold this property until 31st of March 2023. When did I sell it? I had sold it on 1st of October 2022. Now, here there is a catch, and that catch was 5 years from the end of the financial year. Now, if you calculate merely 5 years from 1/5/2017, in that case, you would grant the deduction. You would not deem anything as income. But since it is 5 years from the end of the financial year, 5 years from the end of the financial year in which the possession was taken, the date, the last date would be 31st of March 2023. Had it been sold beyond that, no deeming income, but otherwise here I'll have to add this. So 1,20,000 plus 50,000 plus 60,000. So that gets me to what? Some mistake. Okay. 120 plus 50 is 170. Okay, 230. Yes. D is the answer. See, I hope you're getting it. Why D? So a little tricky, especially in case of house property alone. Let's move further. So this brings me to the end of 80C, section 80C. We've completed that except for some part of 80CCD where I deal with 80C again. Okay, before I move, I'll just go through the queries. Okay, Shubhashish says, if I pay premium against a single premium policy, I won't get deduction for such expense under ATC. No, you will get deduction. There is no problem getting deduction. You have to keep that policy for at least 2 years. See, when it is a single premium policy, you don't terminate it within 2 years. See, I'll show you the provision. The provision is reversal of benefit, wherein any previous year assessee terminates his contract of insurance by reason of failure to pay any premium in case of a single premium policy within 2 years. So you terminate the contract within 2 years in case of a single premium policy, that would lead to reversal of the benefit. Now, this reversal got to be done under income from other sources. I hope you're getting it. Again, even in case of a single premium policy, it is subjected to that 10% limit. So 10% of the capital sum assured. Summary we have already dealt with. 80CCC, 80CCC, contribution to certain pension funds. Any amount paid or deposited to keep in force contract of annuity with Life Insurance Corporation of India. Annuity plan with LIC. We have also talked of annuity plan with others. With that, in case of central government, until 20% of the salary amount kept as annuity available under ATC. This is particular annuity plan with LIC. The deduction under 80CCC is available, right? This deduction under 80CCC is available only to an individual. Annuity pension usually individual. See, annuity or pension funds are not open for HUF anyways, which. And therefore, 80CCC restricts the deduction to individual and not to HUF. So just look at the problem. Okay, Mohammed, your next question is here. Just go through the MCQ. Very, very simple. Alok is asking an interesting question. If it's a single premium policy and I continue the policy for 5 years, the term of the policy is 5 years. Should I claim deduction proportionately? The answer is no. This kind of a proportionate claim is to be done only under section 80D. We'll come to 80D, medical insurance, health insurance policy. In respect of life insurance policy, there is no such provision. You can claim it in the first year itself, subject to maximum of 10% of the sum assured. So long it does not exceed 10% of sum assured, it's fine. Yes. So 80CCC is available only to an individual. I've just told you, annuity and pension plan available to individuals only. Who is going to receive pension? The individual. Then. Okay. So now we move on to 80CCD. We'll just deal with this section and thereafter we'll take a short little break. Right. Contribution to pension fund of central government. See, there was a shift in the pension policy of the government. You would have heard about, if anybody follows elections, every political party is talking of the old pension scheme for government employees. कि हम अगर आएंगे तो हम old pension scheme लाएंगे. Now that old pension scheme is where government gave pension to the retired employee or the family members, which was, taken over by new pension policy, new pension scheme. Under the new pension scheme, what they did is, in the year 2003, 2004, this new pension scheme was introduced for central government employee. And then, even the state governments opted for the new pension scheme only, because it brought down the outlays of the government for payment of pension. What happens is, under this NPS, new pension scheme, or the national pension scheme, under this NPS, the employee contributes. So like EPF, Employee Provident Fund, it is the employee who would contribute and a particular sum, and the employer would also contribute an equal amount to this pension fund, right? Now the employer contribution is taxable. See, the employer contribution is taxable. If you go and rewind yourself to salaries, you'll remember that the employer contribution is taxable. The employee contribution is always out of the taxable income. It is already taxed and he contributes. Now, what the employee contributes is available as deduction, but subject to a maximum of 1,50,000. Subject to a maximum of 1,50,000. We'll discuss this. This limit of 1,50,000 is for three sections: 80C plus 80CCC, 80CCC plus 80CCD subsection 1. Now this subsection 1 of 80CCD deals with this employee's contribution to NPS. Whatever the employee contributes to NPS is covered by 80CCD1. Whatever the employer contributes to the NPS is covered by 80CCD subsection 2. See, employer contribution to fund 80CCD1. Employee's contribution 80CCD1. Employer's contribution, एम्प्लॉय खुद का कंट्रीब्यूशन जो रहेगा 80CCD1 में जाएगा, एम्प्लॉयर का कंट्रीब्यूशन 80CCD2 में जाएगा, राइट. The limit of 1,50,000 is not in respect of this contribution of the employer. We'll come to the detailing of it, but understand it is not for this particular contribution. Employer contribution is added to the salary and thereafter deduction is provided in respect of this employer contribution without any limit, except for a condition that this employer contribution should not exceed 10% of salary. If it exceeds 10% of salary, the amount that is exceeded would be taxable. Simple. So if you remember EPF अगर आपको याद होगा तो वहां पर कंडीशन था, you have to contribute 12% of salary. The employer contribution to the extent of 12% of salary, not taxable. Beyond 12% of salary would become taxable. Here you got to remember only two provisions. CCD1, employee's contribution. CCD2, employer's contribution. Right? CCD2 is out of this consolidated limit of 1,50,000. So in addition to 1,50,000, you'll get this deduction. And this deduction is also available. This deduction is also available under the alternative tax regime. If it has not been done earlier, it would be done in the subsequent lectures. 115BAC is the alternative tax regime. For the time being, understand this is the section where deduction is available. Now, when the employer makes a contribution exceeding 10% of salary, it becomes non-deductible to the extent it exceeds 10% of salary. But for central government and state government employees, this 10% is increased to 14%. So only for those two employees, central government and state government employees. Now I'll show you a small chart. Before we get into the detailing of the provision, let us look at the chart. हम है ना chart से जाते हैं. So I'll just give you the chart. So under the national pension scheme, you've got two kinds of account. One is tier 1 account, tier 2 account. Now this tier 2 account, is very, very specific. This is available only to central government employees. Only to central government employees. Here, central government doesn't contribute anything to tier 2 account. So it is very limited. The scope is very limited to central government employee. And this deduction for central government employee who contributes to tier 2 can be claimed under 80C, section 80C. Remember, we had discussed that last point while we discussed 80C, and that was this tier 2 account. This tier 2 account is kept for minimum 3 years, available to central government employee under section 80C. What is available under 80CCD, therefore? Only contributions to tier 1 account. Now, who contributes to the tier 1 account? Both the employer as well as the employee, right? So if employee contributes, we get him to 80CCD 1. And if it's the employer who is contributing, we take him to 80CCD 2. See, an employee can contribute to the tune of maximum 10% of basic plus DA. Employee contribution would be restricted to 10% of basic plus DA. But this deduction under 80CCD1 is subject to 80CCE. Now, what is this 80CCE? 80CCE says aggregate deduction under 80CCD1 plus 80C plus 80CCC should not exceed 1,50,000. So you have to club all of them together and restrict the deduction to 1,50,000 if it exceeds 1,50,000. Right? We'll take up a problem and you'll understand it better. But for the time being, understand employee's contribution 10% of basic plus DA. But then there could be some people who are self-employed. Are they not in need of pension? Is it only, the salaried employee would require pension? A self-employed person could also retire. A businessman, he could also retire. He would also need pension. And therefore, they have covered even the self-employed people under the NPS. Now, for them, there is no employer's contribution. Unka kaun employer hai? Nobody is their employer. Right? And therefore, for them, the limit is 20% of gross total income. There is no salary, and therefore 20% of gross total income. For employee, it is 10% of basic plus DA. But for self-employed, it is 20% of gross total income. Why such, why do I make such distinction? So, bhedbhav kyun kiya maine? For employee, 10% is given under 80CCD1 and another 10% is given under 80CCD2. And therefore, essentially gets 20%. For self-employed, they give 20% under 80CCD1 only. Because there is no employer. Right? Do you get this, friends? Everybody? I hope I am making myself clear. This is very, very simple. You have to read it again and you'll understand. See, very simple. Might sound a little complex, but if you read it again, you'll get it. Now, coming to 80CCD2. Under 80CCD2, if it is a central government or a state government employer, if the employer is central government or state government, they could contribute 14% of basic plus DA. So maximum allowable deduction under 80CCD2 is 14% of salary of that employee. This is not subjected to the limit under 80CCE. Understand? It is not subjected to limit. So 14% could be 2 lakh rupees. Another 2 lakh rupees would be available as deduction. Other employer, it is 10% of basic plus DA. And this employer deduction, see why this deduction is given. First, you have already added the contribution of the employer in perquisites. Under section 17, you have already added this amount. And therefore, deduction is given. But deduction is restricted to 14%. So if the employer has contributed 20%, 6% would be taxable. Then one very good provision came into existence, and that was 80CCD 1B. 80CCD 1B. Now here, any individual who makes a contribution. So any individual who makes a contribution can claim 50,000 rupees of deduction or the contribution actually made, whichever is less. 50,000 रुपए का deduction मिलेगा. This would be over and above the deduction that you have claimed under 80 CCD 1. The provision is simple. If you have not claimed, if a particular employee contributes, let's say 1 lakh rupees, see, go by my example, 80 CCD 1, the employee contribution. We are talking of only the employee contribution. 1 lakh rupees under 80 CCD 1. Now, assuming he has a shortfall of 30,000 rupees. Shortfall of 30,000 rupees in the limit that is prescribed under 80 CCE. Under 80 CCE, the limit is 1,50,000. So he has got some other deduction under section 80C, 80 triple C to the tune of 1,20,000. Already 1,20,000 rupees of deduction is available. There is a shortfall of 30,000. So I take 30,000 out of this 80 CCD 1. What remains? 70,000 rupees with me. Now 70,000 or 50,000, whichever is less, can be claimed as deduction, right? Under 80 CCD 1B by any individual. So he could be an employer or a self-employed person, right? So this is in addition to 80 CCD because 80 CCE covers only 80 CCD subsection 1 and not subsection 1B. Right, friends? Everybody getting this? We'll take a short little example. Just imagine, had this been, a little change, had this been, let's say, 20,000, had this been 20,000, and you had a shortfall of 30,000. In that case, maximum 20,000 could have been claimed, right? Had this been, let's say, 60,000. In that case, minus 30, you would have claimed 30,000 rupees of additional deduction. Yes. So that brings me to the end of 80 CCD. I hope you got it. We'll take up a problem, you'll understand it in a better way. See, we'll just complete this and take a short break. I know I'm just pushing the limits. Okay, we'll take a break. We'll take a break of 5 minutes and continue with the example on hand and then move to the next provision. I hope you're getting it, friends. Take a short little break of 5 minutes. Let us start. Okay. I hope the screen is visible again. Well, Subhashish, क्लबिंग के नोट्स अभी तक नहीं मिले. Okay, I make it a point that you get it into the next lecture. Don't worry. अगर नहीं आए हैं, किसी कारणवश अपलोड नहीं हो पाए, मैं कर दूंगा उसको अपलोड. अगले लेक्चर के नोट्स में आपको वो मिल जाएगा. Then, अच्छा, let's go to the MCQ quickly. See, RIL pays 8 lakh rupees of salary to Miss Rakhi, and it also contributes 1,10,000 to NPS, the National Pension Scheme, for the benefit of employee. Miss Rakhi herself makes a contribution of 80,000 to the NPS. She invests in PPF and NSC to the tune of 90,000 and 40,000 respectively. What is the amount of deduction under chapter 6A? Look at this. Friends, this is dealing with two sections of one family, ATCCD and ATC. Now, ATCCD deals with two contributions. One is the employee's contribution and the other is employer's contribution, isn't it? One is employees and the other is employers. Now, what is given to us? She contributes, see, RIL, that is the employer, contributes 110,000, 1,10,000, 1,10,000 रुपए का contribution employer का है. Miss Rakhi herself contributes 80,000. 80,000 का contribution employee का है. एम्प्लॉयर ने 1,10,000 किया, एम्प्लॉय ने 80,000 रुपए किया. टोटल जो एनपीएस के लिए कंट्रीब्यूशन हो गया दोनों का मिलकर, दैट इज हाउ मच? 1,90,000. Now, deduction in respect of this employer's contribution is available under ATCCD subsection 2, which does not fall under the aggregate limit of 1,50,000. So this is going to be in addition, right? In addition to 1,50,000. But here, the maximum deduction a person could claim is to the extent of 10% of salary. You know, had Rakhi been a central government employee, then it would have been 14% of salary. But she isn't. She's a employee of a private party, right? And private employer. And therefore, this deduction under ATCCD 2 is going to be restricted to the extent of 10% of salary. What is the salary given to us? It is 8 lakhs. Now, we don't have basic plus DA, and therefore, you know, you have to take 8 lakh rupees as the amount of salary. So 80,000 rupees under ATCCD 2 is something I'm going to get without any limit. I mean to say the 1,50,000 rupees of limit is not applicable. So yes, A is something I'm going to get. Understand this. Then what else is given to us? See, ATCCD 1, she has contributed 80,000 rupees under section ATCCD 1. Under ATC, she makes two contributions. One is to the PPF. One is to the PPF account, her own PPF account. She had contributed 90,000. And the other is to NSC, to which he had contributed 40,000. So the total contribution is how much? 1,30,000. What is the maximum available deduction under ATC? 1,50,000. So what is the shortfall? 20,000 rupees of shortfall, isn't it? 20,000 रुपया कम पड़ रहा है, 1.5 लाख रुपए का पूरा डिडक्शन क्लेम करने के लिए 20,000 रुपए कम पड़ रहा है. See, look at this. 1,30,000 rupees is what can be claimed under ATC. 20,000 rupees is still not claimed. And therefore, I borrow that 20,000 rupees from ATCCD 1. So 20,000 rupees is something that I've borrowed. And by borrowed, I mean to say we take 20 to the tune of 20,000 rupees under ATCCD 1. This deduction would of 20,000 would be claimed under ATCCD 1. So that my total deduction is 1,50,000 under ATCCE. See, look at this. So I claim 1,50,000, 130 under ATC and 20 under ATCCD subsection 1. The consolidated limit of 1,50,000 is provided under ATCCE. So that is over. Now, what is the amount of unutilized amount under ATCCD 1? It is 60,000 rupees. 60,000 rupees of my employee contribution is still unutilized. I have not claimed any deduction for that. I have claimed only deduction to the tune of 20,000 out of this 80,000. 60,000 is still not deducted. Now, this 60,000 would be covered by 1B, clause 1B, where any individual makes a contribution to NPS to the extent of 50,000, 60,000 or 50,000, whichever is less. So I'll claim that 60,000 over here in clause 1B. Under subsection 2, that is the employer's contribution, I've already claimed 80,000. And we have already claimed 1,50,000 under ATC and ATCCD 1, right? And therefore, my deduction is all of the above. Look at this. Do you get it, everybody? देखो ये समझ में आ रहा है क्या? क्योंकि अगर ये समझ में आ गया ना तो हो गया काम. Shortfall cannot be set off with employer's contribution. If it is in excess, that is not going to be used for 1B. 1B is only employee's contribution to NPS. What Kojima is asking is, I've got a shortfall over here. I've not utilized 1,10,000 completely. I'm claiming a deduction of only 80,000. So whether the balance 30,000 can be claimed under 1B, the answer is no. Employer's contribution only under ATCCD subsection 2. क्या नहीं clear? No. You're not asking me to explain again. You tell me what did you not get. Then I'll explain you. क्या नहीं समझा है ये अगर पूछोगे तो मैं बताऊंगा. अगर बोलोगे पूरा समझाओ तो नहीं बताऊंगा. You got to be specific. Because it is simple. It is simple. I tried my best. Some of them got it. If you did not get it, which part did you not get? If you did not get the entire thing, do watch the part again and you'll get it. Don't worry. Okay, good. Great. Let's move on to the next provision. See, one miscellaneous thing again at the cost of reiteration, I've already dealt with this. ATCCE provides for maximum deduction under three sections 1, 2, and 3. Subsection 1 of ATCCD, maximum deduction is 1,50,000. This is aggregate. This is aggregate deduction maximum 1,50,000. This point, Kavita, should clarify your doubt as far as point C is concerned. See what is allowed as deduction under ATC 1,50,000. ATCC E provides for a consolidated limit of 1,50,000 for three sections. तीन सेक्शन है देखो ATC, ATCCC और ATCCD1. इन सबको मिलाकर 1,50,000 के ऊपर इनकम डिडक्शन नहीं हो सकता है. डिडक्शन कैन नॉट एक्सीड 1,50,000. Under ATC, I have got a deduction of 1,30,000. 90,000 rupees towards PPF and 40,000 rupees towards NSC. So I'm not completely utilized ATCCE to the extent of 20,000. So I claim 20,000 from ATCCD 1. Kojima, I have answered your query relating to whether shortfall in ATCCD1 can be set off with ATCCD2. No, ATCCD2 is independent. ATCCD2 deals with employer's contribution. Both the contributions are different. It cannot be set off. Now, okay. Let's move further, friends. Well, it's too much of a dose today, and therefore, I'm not taking up 80D today. The reason is, again, I'll take up a few more complicated things. We follow the examination approach. In the examination, what we do is generally solve the easy ones first. We have dealt with one difficult one, that was ATC and ATCCD. So enough for today. We take up small provisions relating to deduction. So 80D, I'll deal with it, in detail in the next lecture. For the time being, what I'll do, we've got a big chart for 80D at this point in time. But then, I don't want to complicate it further. We've got half an hour left. We'll complete a few small provisions. Let's go to 80DD. See what 80DD gives deduction for. 80DD gives a deduction in respect of maintenance, including medical treatment of disabled dependent. Right? What happens? This is a benevolent provision. Why do I say that? Here, benefit is given to an individual who is taking care of a disabled person, right? One who is dependent on him. A disabled who is dependent on him, if he's taking care of a disabled, this is government's way of providing solitude or, or some concession to that person, to that individual who is taking care of a disabled dependent. Now, who is a disabled? Well, a disabled is somebody who has got, either permanent disability or disability of a grave nature. Well, let me read for you what kind of disabilities are covered. Now, the disabilities, disabilities are the kind of disabilities have the meaning that is specified under the Person with Disabilities, Equal Opportunities, Protection of Right and Full Participation Act of 1995. So you have to refer to a different act altogether. But then, let's understand in a brief. You don't have to get into detail of it. What kind of disability is covered? If you just understand the logic of what kind of disabilities are covered, you will get the deduction, why the deduction is granted. So In respect of disability, what it covers is blindness of a person, low vision of a person, leprosy, hearing impairment, locomotor disability like loss of limb, loss of hands, legs. है ना, अगर कोई कुछ ऐसा हुआ है तो मेंटल रिटार्डेशन अगर हुआ है कोई डिपेंडेंट का तो मेंटल इलनेस है किसी प्रकार की. So these are all the disabilities. Yeah, you could easily understand that it is very grave in nature. And if any person, if a resident individual or HUF, now here both individual or HUF is covered. So either the family is taking care or the individual is taking care of that disabled and any amount. So if he incurs any amount for medical treatment. Now medical treatment need not be only medical treatment by a doctor. Medical treatment could be anything. It could be nursing or training of the disabled dependent, or putting him into rehabilitation. That would also be covered. So any kind of expenditure, if such individual incurs any expenditure, so it could be 5,000, 10,000 rupees for the entire year. In that case, he gets a flat deduction of 75,000. See, I'm coming to the second part of it, but for the time being, understand, if the individual incurs any expenditure for a disabled dependent in respect of medical treatment, training, rehabilitation, in that case, he gets a flat deduction of 75,000. He incurs 10,000 rupees of expenditure, 5 rupees of expenditure, yet 75,000. Now, if a person is severely disabled, like disabled normal, for more than 45% of disability, if he's a severely disabled person, more than 80% of disability, usually, there could be a person who could be bedridden. Now, if he's so bedridden, in that case, it is more grave in nature, and therefore, an enhanced deduction of 1,25,000 would be granted. So more than 80% of disability, 80% or more, 1,25,000. Now, who decides 80% or 45%, 50%? Well, it is the medical authority. Now, who is the competent medical authority? It is usually the civil surgeon. The civil surgeon. Every town has got a civil hospital, and that civil hospital would have a civil surgeon. That civil surgeon would certify that yes, this person is disabled under the Person with Disabilities Act of 1955, 1995, and he would grant a certificate in form 10IA. 10IA is the form wherein he will certify that yes, he is disabled. So if he certifies 80% or more of disability, in that case, you could claim 1,25,000 rupees of deduction. Now, this provision has seen an amendment from AY 23-24. Let's check it out. Although it's not covered here in the note somehow, but then I'll explain it to you. See what happens. So, resident individual or HUF, he incurs any expenditure on medical treatment of disabled dependent, he could claim 75,000 rupees. Now, if that resident individual does not incur, assuming he does not incur any expenditure on medical treatment, whether he could do anything else, the answer is yes. He could deposit. So he could either pay or deposit any amount in a scheme framed. So there is a specific scheme framed by the Life Insurance Corporation of India for the benefit of such disabled dependent. So who's the beneficiary of the scheme? It is the disabled dependent. When does he start to get benefit? After the death of this individual, right? So why I would deposit in a scheme with LIC? Let's assume there is a person who is dependent on X. What happens to that disabled person after X dies? So he would be he would not have that financial security, that dependent. In order to ensure financial security for that disabled dependent, what X does? X contributes in a scheme of life insurance corporation. Now, if he does so, well, he can claim a deduction flat of 75,000 or 1,25,000 as the case may be. Now, earlier, this scheme that was framed by the LIC did not give any amount to the dependent until the death of the individual. So if only if the person on whom he is dependent, in our case Mr. X, let's say Mr. X is a father of a disabled dependent, let's say Y. Now Y would not get benefit under this scheme until the death of X. And therefore, there was an amendment brought in. They said, no, if X reaches 60 years of age, now, in fact, when he reaches 60 years of age, even he would need support. And therefore, if he reaches 60 years of age and this policy matures, no more contribution is made to this particular policy or the scheme, in that case, any amount can be received by Y. Even that policy would be covered. So any contribution to a scheme of LIC, well, that is allowed. Who's a dependent? In case of individual, it is spouse, children. Now here there is an extended definition of family. While we were talking of ATC, we were talking only of spouse and children. Here it is spouse, children, parents, brother, sister, right? Who's dependent on that individual. So even a dependent brother or a dependent sister would also be covered for the purposes of deduction under 80DD. Understand, friends? In case of individual himself is not covered over here. Individual himself is covered under another provision, section 80U. It is an identical provision, 80U, right? We'll just have a look at 80U also. Individual himself if he is disabled, he can claim under 80U. But individual who has got a disabled dependent in the nature of spouse, children, parent, brother, sister, he can claim a deduction under 80DD, provided he incurs a medical expenditure or he goes for a insurance. I'm not talking of insurance. It's a scheme framed by the Life Insurance Corporation. Now, this scheme is proposed by Mr. X. So this is not an insurance of Y. It is, the proposer is X and the scheme is for the benefit of Y, only benefit of Y. In event of death of X, Y would be a beneficiary, right? Or in event X reaches 60 years of age, Y would start getting benefit of the scheme. Yes. So flat deduction of 75,000 in case of severe disability, 1,25,000 for individual. For HUF, it could be any member of that HUF who is disabled. Who's dependent? A person who is wholly or mainly dependent on the support and maintenance. If a person is not dependent, in that case, he can claim deduction under 80U. Right? Got it, friends? Everybody, look at this. Okay. We will just go by one of the MCQs to understand it better. Subhashish, in respect of your query, the answer is yes. If you have claimed ATC, you can also claim 80DD. Yes. 80DD is independent of ATC. I've started getting answers. Some of you are saying 75,000, some of you say 40,000. Anybody who says 15,000? Okay. So a lot of B's there. See, I'll just move you through the problem. Mrs. X paid 25,000 to Life Insurance Corporation under a approved scheme for his disabled son and incurred rupees 15,000 for treatment of his disabled husband working in a bank. Now understand this, why this information is given. See, Mrs. X has got a disabled son who would be dependent on Mrs. X. She could claim a deduction of 75,000 rupees because she had contributed 25,000 rupees. Any contribution, you claim a flat 75% of deduction. However, in respect of expenditure made for his husband, now that husband is not a dependent, understand, husband is not a dependent, and therefore no deduction is going to be allowed in respect of husband. Husband can claim deduction under section 80U of the act, right? So that is going to be there. She could claim deduction of 75,000. We have not been given whether it is a severe or non-severe disability. Had it been a severe disability, it would have been 1,25,000. But anyways, which we don't have 1,25,000 in the option, and therefore 75,000 is the correct answer. And not 25,000. 25,000 is the amount of expenditure. But we get a flat deduction of 75,000 even if you incur 10 rupees of expenditure or you make a contribution of rupees 10. Next. I hope 80DD, disabled dependent. See, very simple, 80DD, disabled dependent, DD. Now moving on to 80DDB. Under 80DDB, friends, deduction is allowed in respect of medical treatment of a specified disease or ailment. Now, these are again chronic diseases. If I read for you, what kind of chronic diseases are covered, you would understand that it is not available to every individual or HUF. It is available only in exceptional cases. So the chronic diseases which are covered here are neurological disease, dementia, aphasia, Parkinson's. So chronic, motor neuron disease. So these are all chronic diseases, malignant cancer, AIDS, chronic renal failure, thalassemia. So all these, are covered. Now, the maximum deduction under 80DD is 75,000 for all disabled dependents taken together. However, in respect of 80DDB, you claim deduction if you're an individual or an HUF in respect of any amount paid for specified diseases, right? So specified diseases is something that I've just dictated. An individual for himself or a spouse who is dependent on him, children, parents, brother, sister, right? Similar to the 80DD family who is dependent, and if he incurs expenditure on himself. Now, himself is also covered, right? So a person who incurs some expenditure in respect of those chronic ailments, he could claim deduction to the extent of the actual expenditure. So this is not a flat deduction, only to the extent of actual sum paid or rupees 40,000, whichever is less. So maximum expenditure on chronic diseases to the extent of 40,000. Now, if that person is a senior citizen or the dependent is a senior citizen, in that case, actual amount paid or rupees 1 lakh, whichever is less, right? Actual amount paid of 1 lakh rupees, whichever is less, minus the amount. If we have got a insurance and medical healthcare insurance and you get some reimbursement from that insurance policy or from the employer, nothing is, that amount will be not deductible. So you should have actually expended that money. I hope 80 DDB is clear. Very simple. See, look at this small little MCQ. I don't think it is worth the time, but the maximum possible deduction under 80 DDB for senior citizen. Yes. Just a second, friends. It's coming. By the time you just read the MCQ, give an answer. Okay, good, great. Yes, it's the answer is C. Indeed, it's C. All of you have answered. Now I'll take you to a sister provision for of relating to 80DD. We go to 80U first, right? I know I'm skipping the the chronology, but then with an objective of dealing with the sister section 80U, let's go to section 80U at the last. That's the last provision under chapter 6A. Now it deals with deduction in respect of a person with disability. Who can claim deduction? Only an individual, a resident individual. More so, you have to also take care of the terminology. It is the resident individual alone, right? Who could claim deduction in respect of a person, if he is a person with disability. Individual himself who has got disability, in that case, if he is so certified by a medical authority, under 10 IA form 10 IA, in that case he could claim deduction. Well, to my mind, you did not remember the ailments or the disability. Usually in the problem itself, it would be given to you that he is severely disabled or he is disabled. So no need of doing that. I just gave you a list only for your, so that you could understand the nature of disability. So it takes into account chronic ailments like cancer, neurological diseases, malignant cancer or renal issues, chronic diseases are covered. Flat deduction of 75,000 in case of person with disability, normal disability 75,000. Flat deduction of 1,25,000 with severe disability. Yes. So 80DD deals with expenditure in respect of disabled dependent, provided you incur some expenditure expense or LIC scheme contribution. 80U deals with assessee himself. One who is not dependent can claim deduction under 80U. In our example, the husband was a bank employee. He was not dependent and therefore he would claim deduction under 80U. And this provision grants a plenary deduction. You don't have to, you don't have to incur any kind of expense over here. No condition related to expenses are given. Expenses, condition related to expense, some expense is given only for disabled dependent. In both the section, the maximum deduction is capped at 75,000 and 1,25,000. 80 DDB, on the other hand, covers expenditure in respect of diseases, right? Big diseases, right? What are those big diseases? So it could be malignant cancer, AIDS, or something like that, very, very chronic. And the deduction is in respect of any dependent or the individual himself. So if the individual is incurring some expenditure for himself also, that would be covered. But then it is restricted to actual expenditure on such diseases or rupees 40,000, whichever is less. If the expenditure is done on a senior citizen, then you can claim deduction up to rupees 1 lakh rupees or actual expenditure. Yes, I hope it is clear. Pranev, I hope it is clear to you what is the difference between 80 DDB and DD. So we've covered this. Well, Subhashish has got a question, LIC premium paid. We're not talking of premium over here. We are in 80 DD. We're not talking of insurance premium, friends. We are talking of a scheme for the benefit of the disabled. Don't mix it up. It's not a insurance policy. It is a scheme run by the Life Insurance Corporation of India. Now, Life Insurance Corporation does not merely give insurance policies. It also runs certain schemes. If the scheme is approved under 80DD and is for the benefit of the disabled dependent, that alone would be covered by 80DD. It is not covered by 80C. This contribution is not covered by 80C. The contribution under 80DD is not covered under 80C because it is for a scheme for the benefit of the disabled. In fact, the maturity proceeds, if it comes to the individual and not to this dependent, if it is coming to the individual, it is taxable in the hands of that individual. Okay, let's move ahead. So I hope 80DD and DDB is clear. Let's move to the next set of deduction. Okay, for the time being, I'm skipping 80E. 80E with fresh mind will do. Come to section 80EEA. I'll skip 80EE also. 80E is very simple. But first, let's understand what is, currently we can claim deduction 80EEA. Deduction in respect of interest payable on loan from financial institution for acquisition of residential house property. For acquisition of residential house property. Now, when you read the heading itself, you would find here interest on acquisition of house property. This is something we have already dealt while we were studying house property. So under 24B, already the deduction for interest is granted. Why do we need another section for that? Now you'll recollect that when it comes down to acquisition or construction of the property, and if that property is self-occupied, then 24B, deduction under 24B is restricted to rupees what? 2 lakhs. Isn't it? Maximum deduction could be 2 lakh rupees. Similarly, we saw another section, and that was section 71B, if I'm not wrong. Now, 71B dealt with carry forward of losses arising out of house property. And there, 71 also, section 71 and 71B. 71 also gave us that, in fact, section 71 is a more appropriate authority. It did give us a rule, and that rule was house property loss can be set off only to the extent of 2 lakhs. Maximum 2 lakh rupees of house property loss could be set off, and not more than that. Similarly, for self-occupied house property, I've got a maximum deduction of 2 lakh rupees. Now, what if I'm paying more than 2 lakh rupees of interest? Let's say I'm paying 3 lakh rupees of interest. Now, in such a case, my deduction is restricted under 24B to the tune of 2 lakhs. And therefore, in order to provide additional incentive to first-time buyers, we are talking of first-time buyers who do not hold any other house property. So by first time, I did not mean literally first time, who do not have any other house property. First house or the only house. And you're taking a loan, right? Then deduction in respect of interest would not only be allowed under 24B, but would also be allowed under 80EE to the extent it is not allowed under 24B. So under 24B, let's assume I have claimed a deduction in respect of interest for acquisition of residential house to the tune of 2 lakhs. Out of the 3 lakh, 2 lakhs have been claimed under 24B. Remaining 1 lakh I could claim under 80EE. Right? Getting this, friends? But this additional deduction comes with conditions. What are the conditions? First, the loan should be taken from a financial institution. 24B did not give us any such condition. Here, 80EE says it should be from a financial institution. What is that financial institution? It is either a housing finance company or a bank, right? So you're not taking loan from individual or from an NBFC and claiming deduction under 80EE. You could claim only if it is from a bank or a housing finance company. What is the maximum amount allowed? 1,50,000, right? So maximum allowable deduction, 1,50,000. What are the conditions? Conditions are loans should be sanctioned. We are talking of sanctioned, right? So it may or may not be disbursed, but it should be sanctioned up to 31st of March 2022, right? See, it is the preceding previous year. What previous year is applicable to your examination? 20 to 23. We are talking of 21-22. Financial year 21-22, the loan should have been sanctioned. Then you have purchased a property with a stamp duty value, which has got a stamp duty value. Now, this stamp duty value you have already seen under section 50C and section 56(2), right? You have already seen it over here, and therefore I'm not again getting into it. But which has got a stamp duty value, which is generally given by the government for the purposes of calculation of stamp duty. The stamp duty value of the house property is lesser than or equal to 45 lakhs. So essentially, it comes as a relief to middle class, right, or lower middle class who are buying a small house, right, which has got a stamp duty value of lesser than 45 lakhs. And the individual should not own any other residential house on the date of sanction. So on the date of sanction, he should hold no house. Thereafter, he could hold, but on the date of sanction, no house should be there. Only then then that individual shall be eligible for deduction under 80EE. And he should not be covered by 80EE. That I'll cover in a short while. But for the time being, understand, if you look at this, it is only for the purposes of providing additional incentive to first home buyers who buy a small property, affordable housing to the extent of 45 lakhs, and the sanction of that loan is done prior to 31st of March 2022, right? Then you could claim deduction, additional deduction under 80EE. Let me just take you through an example, and we'll understand the provision well. See, look at this. Are you getting it on the screen? Piyush, are you there? I don't think he's there today. So Piyush has taken a loan from a scheduled bank, right? Now you understand that it is a financial institution. It is from a scheduled bank. Bank and HFCs, housing finance companies, are allowed for purchase of its first house. So it doesn't own any other house. This is also clear from the adjustment itself, which is self-occupied, right? During 20 to 23. So he has also self-occupied it. So maximum deduction under 24B, I know, is 2 lakh rupees. The loan is sanctioned in March 22. March 22, the loan was sanctioned. The first disbursal, though, was done in July 22. That is financial year 22-23. The disbursal had happened. I'm discussing this because I think it is a little complex to understand. And therefore, directly without waiting for your answers, I'm discussing it. Disbursal in 20 to 23, sanction in 22, March 22. So sanction 21-22, disbursal 22-23. The stamp duty value of the property was 42 lakhs. The actual purchase price paid by Piyush was 50 lakhs for the house. The loan taken was 40 lakhs for at the rate of 10%. What is the amount of deduction under 24B and 80EE, assuming no repayment of loan? Right. Now, first tell me whether all the conditions are of 80EE are satisfied. See, my condition number one for 80EE, just take it a little down. See, my condition was that the loan should be sanctioned between 1st of April 19 to 31st of March 22. When was the loan sanctioned in case of Piyush? It was sanctioned in March 22. That is prior to 31st of March 22, it was sanctioned, and therefore I am okay with the first condition. The second condition is that it should be an affordable property. So what did they say? The stamp duty value should not exceed 45 lakhs. So whether 42 lakh rupees is lower, the answer is yes, isn't it? Stamp duty value is lesser than or equal to 45 lakhs. So my second condition is also satisfied. Now I have nothing to do with the actual purchase price. Actual purchase price might be more, right? It is more than 45 lakhs. We are concerned with the stamp duty value, right? Now the loan amount is that of 40 lakhs. So my annual interest is what? My annual interest is 4 lakhs, right? However, when did I take the loan? I have availed the loan in July, on 1st of July 2022. So in fact, I have used this loan of 40 lakhs only for 9 months out of the 12 months. So what should be the amount of interest? I think for the current year, the total amount of interest, what is it? Can anybody tell me? 4 lakhs into 9 divided by 12. It's 3 lakhs, isn't it? Do you get it, friends? Everybody? Yes. So 3 lakh rupees of interest I have paid during the current year. Out of this 3 lakhs, 24B, since it is a self-occupied house property and the loan is taken for construction of the or purchase of the house, 2 lakh rupees would be subsumed under 24B. Interest on home loan to the extent of 2 lakh rupees, सेल्फ ऑक्यूपाइड है देखो हाउस प्रॉपर्टी, 2 लाख रुपए तक का डिडक्शन कहां मिलेगा मेरे को? 24B में मिल जाएगा. बचता कितना है? 1 लाख रुपया. Now this 1 lakh rupees, since all the conditions of 80EE have been satisfied, I could claim 1 lakh rupees under 80EE, right? So I should go with answer B and not answer A. See what could have happened if you would not have done this 9 multiplied by 9 divided by 12, you would have thought the interest was 4 lakh rupees and you would have claimed 1,50,000 and 2 lakh rupees. But that is not the case. It is 2 lakh rupees and 1 lakh rupees under 80EE. Now, what could have happened is, let's say here this stamp duty value would have been 48 lakh rupees. If that was the case, again 80EE would not apply. And then you could claim only 2 lakh rupees of deduction because the stamp duty exceeded 45 lakhs. Getting this, friends, everybody? 80EE. Yes, Piyush got it right. All right. So 80EE is complete. So I've just given you a small note on it, and we have already taken a problem. So I'm not repeating it. You could just go through it. Section 71(3)(a). There's a limit of 2 lakh rupees, and therefore 80EE comes to the rescue. 9/12 क्यों किया? क्योंकि जो लोन लिया था वो जुलाई में लिया था, तो मैं पूरे साल भर का इंटरेस्ट क्यों पे करूंगा? आई पे इंटरेस्ट ओनली फॉर 9 months. Similar provision like 80EE, we have 80EE. Now this 80EE is, factually defunct, but then all those loans which were sanctioned in the previous year 16-17, financial year 16-17. See, here we were talking of financial year up to 31st of March 22 from 2019, 19-20, 20-21, 21-22. So we had a 3 years window. Here we in 80EE we had only 1 year window, and if the loan is sanctioned during this period, if it is a first house, you don't owe any other house, the value is less than 40 lakhs, loan sanctioned is less than 35 lakhs, then you could claim 50,000 rupees of deduction, right? So prior to 2019, there was a scheme 80EE which was operational in 16-17. The deduction maximum was 50,000 only, right? Good. I hope you get this. Now, similar to 80EE, we have got another provision, that is 80EEB. 80EEB करके एक प्रोविजन हमारे पास में, जिसके अंदर हमको डिडक्शन मिल रहा है. डिडक्शन इन रिस्पेक्ट ऑफ इंटरेस्ट पेएबल on loan taken from financial institution. Now here financial institution means banks or NBFCs, certain NBFCs, non-banking financial corporations. So here we don't have National Housing Bank because it has not, EEB has got nothing to do with housing properties. So banks or NBFCs for purchase of electric vehicle. So electric vehicle, if you're buying an electric vehicle, right, you get the deduction in respect of interest payable. We want to promote green energy, isn't it? And we want to promote the nature should be preserved, and therefore electric vehicles is the future. In order to give incentive to people to buy more of electric vehicle, EVs, A deduction of 1,50,000 is allowed in respect of interest payable for the loan taken to purchase such electric vehicle. The loan should be sanctioned by a financial institution up to 31st of March 2023. Right. So if it is so sanctioned up to 31st of March 2023, the amount of interest that you pay on purchase of an electric vehicle would be allowed as deduction under 80EE, provided the loan is taken from a financial institution. It could be a bank or a NBFC. Now understand, friends, did the deduction in respect of borrowed capital not be allowed under section 136(1)(3)? It was always allowed under section 36(1)(3), isn't it? Interest on borrowed capital under the head of PGBP. So if the electric vehicle is used for the purposes of business, you could always claim it under section 36(1)(3). But then if the electric vehicle is your personal vehicle, then no such deduction was earlier allowed. But now because of a specific provision under 80EE, you can claim it. Usually the salaried employees don't get any kind of deduction, but this can be claimed by them provided they buy a EV and the EV is bought out of loan sanctioned by a financial institution and they pay interest to the extent of 1,50,000 alone would be allowed as deduction. So if a person, if an individual, see it is applicable only to an individual. If an individual is paying 5 lakh rupees of interest, he buys a Tesla, right? And that Tesla is going to cost him a crore of rupees, and he would end up paying a lot of interest. So if he pays 5 lakh rupees of interest, the maximum deduction he could claim is only 1,50,000. I hope 80EE is clear, right? So we have completed a lot of sections. We have got a few sections that we take care of in our next lecture, right? But now the deductions are very, very specific. They don't cover a huge, canvas like ATC. It covered everything, insurance and PPF, etc., etc. Now these are all particular sections covering only select aspects, right? So I hope everything is clear. I hope you've enjoyed it. I've tried to take more examples so that you learn the provision by way of example rather than the provision itself. Provisions you could always read. I've already told you that module is the best source. You could go through the module. I've given you notes for the sake of your reference. May not be that useful, but then yes, still you could refer to them if at all you don't understand anything or you want to read a particular provision as it is. See, these are only 18 pages, so you could immediately brush it up. So that is the objective of giving you notes, but it's not a substitute. I've got a few queries though. 80EE deduction is applied until the loan is repaid. No, 80EE, yes, very important point. 80EE deduction would be available till the loan is repaid throughout. It is not only in the first year. You could claim it in the subsequent year. And therefore, 80EE also becomes important. Why I've taken up 80EE? Only because of that. There could be a loan which was sanctioned in 16-17. A person is paying interest today. He can claim deduction under 80EE because 80EE is not applicable to him. 16-17 sanction. 19-20, 20-21 and 21-22. Only these 3 years are covered by 80EE. So yes, Kojima, you're absolutely right. It is available throughout and not only for the first year. Loan sanctioned and disbursed in March 22. I've just deleted the MCQ. Priyanka is asking a question that if the loan was sanctioned in March 22 itself and disbursed in that year only and there would have been no repayment, in that case, 4 lakh rupees would have been the available interest, out of which 2 lakh would be claimed under 24B and remaining 1,50,000 would have been claimed under 80EE. Yes. Pranav, father is holding a house on his name and his son wants to purchase a house. Well, yes. See, son and father are two different individuals. So it is not the family should own only one house. That person should not own any other house. So Pranav, you can always go and buy a house property and claim 80EE if you do not have any other house in your name. All right. I think I've clarified all the queries. I hope you guys enjoyed it. It was quite a marathon, but then okay, we would come to the end of deductions in the next lecture, anyways. Which all right. Thank you, friends. I'll end the meeting.